Okay, everybody, welcome back. This is the second part of Chapter 14, which is the finance chapter. And we want to pick up, we just finished in the part 1 talking about the different types of loan purchase programs and different types of federally backed loans versus conventional loans, and Freddie Mac, Ginnie Mae, Fannie Mae, all those various entities. The second half of the chapter here picks up on page 321 to 322, and we're going to talk about how buyers are qualified for loans, what kinds of things lenders use to qualify buyers to purchase a property. And there's going to be some math involved here, but hopefully we'll get through that pretty well. It's not too terribly bad, I don't think. And if you have questions, obviously we'll talk about those as you have them in class. But the process for determining if a buyer is eligible for a loan is a really important one, obviously, in our business. And we want to make sure that we have buyers that are qualified. Now, one of the things you as a broker can do is learn what things go into qualifying those buyers, so that you have a good feeling or understanding of what buyers are going to be qualified, what buyers aren't going to be qualified. Maybe you have to discuss with the buyer why they didn't qualify and what things they can do to help qualify in the future. So on page 322, it sort of introduces you to the credit score and the importance of the credit score. There's not much you'll be tested on here, so I don't want to spend much time on that. But there are several things that affect credit score that may not be very straightforward. So I really suggest at some point you talk to lenders. If you have questions, you can certainly ask me about the kinds of things that affect credit score. Credit history is obviously a very important piece of the puzzle when it comes to qualifying for a loan. You want to have somebody with good payment history. The more late payments they have, the less likely they are to obtain a loan. The higher their credit usage is. In other words, if they are close to their maximum available credit on a lot of credit cards, that's generally considered a bad sign, and that sort of thing. As far as qualifying for the different types of loans, every loan has its own set of qualification rules. Yeah, if it's a conventional loan, there's probably going to be a set criteria by the bank themselves. If it's something like an FHA loan or a VA loan, they're probably going to use the basic Fannie Mae requirements. And that's simply because they want to make sure that Fannie Mae is going to buy that loan after it's been issued. And so they'll use those as basic minimum requirements for issuing the loan. But one of the things that we can talk about that really doesn't relate to credit history and or credit score is something called maximum affordability. Now, I'm going to email to you along with the instructions on how to get to these videos. So if you've gotten to the video, you've gotten the instructions as well. You're going to get a sheet, a PDF that's called Buyer Loan Qualification, and this is something I've given out for a few years now in my class that gives what I think is a better description of how we qualify buyers. And it says that, if you sort of take it out and read along, I'll do my best to keep it on the screen, but it'd be best if you read the version I've sent to you as a PDF. Buyers are qualified for mortgage loans based on a comparison of their monthly gross income and their monthly debt. In other words, we're going to look at how much they make on a monthly basis. And notice monthly is in bold and caps there. Monthly gross income, so income before taxes on a monthly basis, and their monthly debt obligations. So those are the two things that we're going to take a look at when we're qualifying a borrower to figure out if they qualify for a loan, is their monthly income and monthly debt. And it says here that generally lenders want to know that a borrower is not spending more than 28% of their monthly income on housing expenses and not more than 36% of their income on total debt payments. So let me give you a visual representation. You know, my lovely drawing skills, we've seen those before in class, sometimes with hilarious results. But I do think a visual representation helps an awful lot when you're dealing with stuff like this. here I've got my two buckets of money, and these are my qualification buckets. And on the top, I have a bucket of money called the 28% bucket, the housing bucket. And on the bottom, I have a bucket of money called the 36% bucket, the total debt bucket. And if you notice, there's money in each bucket. The idea here being that we want to take our total monthly gross income. So if I make $36,000 a year, my monthly gross income is $3,000. Once I have that $3,000, then I can determine how much money goes in bucket 1 and how much money goes in bucket 2. With a monthly $3,000 gross income, I'm going to first take that $3,000 and I am going to multiply it times each one of these qualification ratios. And this one is called the front end ratio sometimes, and this one's called the back end ratio. Front end ratio, back end ratio. And you won't be tested on those terms, but if you ever hear a lender, you'll know what they're talking about. And these numbers are not standardized. It's not always 28% and 36%, but those are the numbers most commonly used on the exam, and they were traditionally the most common numbers. So those are the numbers we teach in the class. But these numbers, this one could be, 33%, and this one could be 45%, depending on the rules of that particular lender and that particular type of loan. But we use 28 and 36 most commonly in the class. Sorry about that. Put these back up. So, if we have that monthly gross income, as I said, of $3,000, we can take that and multiply it times 28%. And I'll sort of show you here what we're doing, if I can. 3,000 times 28%, and that gives us $840, okay? Because it was the 28%, that $840 is how much money we have in our housing bucket. Our housing bucket now has $840 in it. So I'll try to label that up here for you. So with a monthly income of $3,000, we've got $800 in our housing bucket. We also have to figure out how much money is in our total debt bucket. So we're going to take the same $3,000 monthly income times 36%. And that's going to give us a monthly debt allowance of $1,080. So our total debt bucket has got $1,080 in it. So let's talk about the expenses that are allowed in each bucket. The goal here is to make sure that the buyer makes enough money to qualify for the loan. We've already looked at their credit score. We've already looked at their credit history. Now we want to make sure they make enough money to qualify for the loan. And the way we check to make sure they make enough money is we check to make sure there's enough money in each bucket. That it's as simple as that. So we want to look at bucket number 1. We want to look at the housing bucket, okay? Change to a different picture here. This is the housing bucket by itself. All right? And if you take a look at the housing bucket by itself, I'll tilt that down and get a better picture. If you look at the housing bucket by itself, you see that our 28% bucket actually has to cover a lot of expenses. Primarily and specifically, the expenses that relate to purchasing and owning the house. Principal, the principal payment on your loan, the interest payment on your loan, the property taxes on the house itself, the insurance on the house, and any HOA payments. So going back to our first drawing here and relating that back to our real world example, how much money do we have in our 28% bucket? We have $800 in there. That means in order to qualify for this loan, we have to make sure that when we look at, Try to get both of these in there at the same time. We have to make sure that when we look at that 28% bucket, that $800 will cover our principal, our interest, our taxes, our insurance, and our HOA. Principal, interest, taxes, insurance, HOA. We have to make sure that those are all covered by that $800 that we have sitting in bucket number 1. When I start pulling out how much the principal payment is, and I pull out the taxes, and I pull out the interest, and I pull out the insurance, and I pull out the HOA, if at any point I run out of money before these things are all paid, then we don't qualify. That's the idea here. Anytime I run out of money, if $800 in our example here won't cover all of those expenses, then we don't qualify. It's as simple as that. Now, hopefully, we've taken their monthly income and we figured out that they can afford $800 to cover their housing expense. And we call these things added together, we call them the housing expense. Because all of these expenses, all of these things added together add up to basically our house payment, right? Our principal, our interest, our taxes, our insurance, and our HOA all added together, that's our house payment for the most part, for most people. And so, as long as our house payment doesn't equal more than $800, so far, so good. But we're not done. We haven't talked yet about this other bucket. We haven't talked about this $1,080 that's in our total debt bucket. So let's take a look at bucket number 2. Bucket number 2 is the total debt bucket. And bucket number 2 tells us or shows us that we have to have enough money in there to cover everything that was in bucket number 1. Look at that. Housing, principal, interest, taxes, insurance, plus HOA. So everything that was in bucket number 1 is automatically also in bucket number 2. And we also have to have enough money left over to pay for our credit cards, our car payment, our student loans, our debt. And that's the key word here, debt. Any debt that we have has to be covered in this bucket of money. So now go back to our original drawing. In our housing bucket with our $3,000 monthly income, we had $800 to spend on our house payment, on this stuff. Well, let's assume we spent all $800 on that stuff. That stuff is still in bucket number 2. And once that stuff comes out of bucket number 2, how much money is that going to leave us with to pay for our credit cards, our car payment, our student loans, our debt? Well, it's going to be the difference between these two. If we spend $800 of our total $1,080 on the housing piece, then we can only spend $280 on the debt. If we spend less than $800 on the housing piece, then we can afford more on other debt. But it doesn't work the other way. We can't spend less here and spend more than $800 on the housing, because the key here is we have to qualify under both of these ratios. Both of these have to be a yes. We have to have enough money in both buckets in order to say, yes, this person qualifies for the loan. So, they can't afford to spend more than $800 a month on their house payment. If you check that, and that's okay, then you go and you check bucket number 2. And you say, okay, are they not spending more than $1,080 on their housing plus all their other debt? And if that's also okay, then they qualify for the loan. But if either one of these answers is no, they don't qualify. Okay? You have to check both sides when you do this buyer qualification thing. You always have to check both the 28% bucket and the 36% bucket to make sure that they qualify under both ratios. If they don't qualify under both ratios, they don't qualify at all. It's as simple as that. There's no ifs, ands, buts about it. If they don't qualify under both of the ratios, then they simply don't qualify. Okay, so now that we've kind of gotten our visual representations there, let's take a look at the examples that you've got on the worksheet I sent home, or that I emailed rather, that I held up earlier. Okay? So, it says, for example, hold this up here again. For example, a buyer has a monthly gross income of $5,000 and credit card bills of $450 a month. How much of a housing expense can the buyer afford? So again, we've got to set up our two buckets. A buyer has a monthly gross income of $5,000. So I'm going to quickly, and I'll try to write this down and then hold it up for you. I'm going to take my $5,000 monthly gross income, and I need to figure out how much money is in my 28% bucket. So I'm going to take $5,000, and I'm going to multiply it times 28%. And what I find is that I can afford $1,400 a month in bucket number 1. So $1,400 a month in total housing expense. All right? They asked me, though, how much housing can we afford if we have credit card bills of $450 a month? Well, we could afford $1,400 on housing, but we don't know what the other bucket says. So we have to check the other bucket as well. All right? So let's take our same $5,000. And this time we're going to multiply it times 36% because we figure out how much money is in our second bucket. And what we find is that we have $1,800 in bucket number 2. And once we know that, we also know that bucket number 2 contains not just our housing up here, but it also contains those credit card bills that we're so worried about. Well, if they're asking me for just the housing and bucket number 2 contains the housing plus the other debt, I need to subtract out the other debt to figure out how much I can afford to spend for housing. Again, visualize a bucket of money. The bucket has $1,800 in it. I've got to pay the credit card bill, so $450 comes out. Coming out is subtracting. So I'm taking $450 out of my bucket of money. That leaves me with $1,350 available to spend out of bucket number 2. Available to spend on housing. Because that's the last thing that's in the bucket. $1,350 left to spend on housing. Well, the question says, how much of a housing expense can the buyer afford? Well, when I looked at the 28% ratio, the 28% ratio told me that the buyer could afford $1,400. But once I looked further and I did my second ratio and I took out those credit card bills, the second ratio said we could only afford $1,350. Remember, here's what you're doing in situations like this. You are becoming the bank. You are the bank. And when you're the bank, your job is to make sure you get the most qualified buyer possible in a situation like this. And which buyer is more qualified? Or, look at it from another perspective, which are you more comfortable with as a lender? Are you more comfortable with somebody, a borrower, borrowing from you and having to make a $1,400 a month house payment? Or are you more comfortable with a borrower having to make a $1,350 house payment? Which one are they more likely to be able to afford? Well, I think the rational and logical answer is if I'm the lender, I feel more comfortable giving them a smaller loan and them having a lower payment. They probably have a better chance of paying back $1,350 a month than they do of paying back $1,400 a month. So you're looking for the smaller number. This ratio, the 28% ratio, says we can afford to spend $1,400 on housing. This ratio, the $1,350 ratio, says that we can afford to spend I'm sorry, the 36% ratio says that we can afford to spend $1,350 on housing. So we're going to go with $1,350. That buyer can afford $1,350 a month in house payment. Only $1,350 a month. So, now that you have seen that example, I want you to take just a minute and go through and do questions number 1 and 2 here. Okay? Go through and do questions 1 and 2. And you can pause me. And on the other side of the pause, I'm going to go through for you. And we're going to talk about the answers to each one of these questions. We're going to see exactly what would have been the answer to each one of these. All right? So go ahead and press pause. And when you come back, I will give you the answers. All right, so answers to your first 2 examples here, and I realize my chicken scratch key is not very clear, but what we had to do in number 1, it says Bobby Buyer has a monthly gross income of $4,850 with car payment of $325, a student loan payment of $150, and credit card bills of $115. What is his monthly housing affordability? Now, I did not write down here the complete work, and I apologize for that. It's an old key. However, I did take both ratios, and I figured out what Bobby could have afforded for his house payment. If we went with the 28% ratio, Bobby, who makes $4,850 a month, you would take that $4,850 and you would multiply it times 28%, right there, and you would see that he could afford $1,358 a month for a house payment under the 28% ratio. Remember, we've got to check both buckets. So $1,358 under the 28% ratio. We take the same $4,850, and now we multiply it times 36%. That leaves us with $1,746 in bucket number 2. But remember, bucket number 2 has other expenses other than housing in it. So if they're asking us just for the housing piece, we have to subtract out the other expenses. Okay? So we would have to subtract out that car payment of $325. We would have to subtract out that student loan payment of $150. We would have to subtract out those credit card bills of $115. And if we do all that, we find that his bucket, number 2, only has $1,156 left in it. And that's exactly what our answer is going to be. Since this number is smaller than the 28% number, it's $1,156 is Bobby's affordability for a house payment. Remember, it's going to be the smallest payment. Put yourself in the shoes of the lender. Which payment are you more comfortable with a buyer making? A bigger payment or a smaller payment? The answer is always going to be the smaller payment. So you're going to choose the ratio that gives you the smallest answer, and that's how much Bobby could afford to spend on his housing. Now, in question number 2 here, it says Sandy wishes to purchase a home and she has an income of $48,000 annually. If Sandy's interested in a home that would have a monthly pity payment of $940, how much can she afford for other monthly debt such as car payments? Well, in this one, we don't need to look at the 28% ratio because the only one of these buckets, the only one of these ratios that deals with other debt is the 36% bucket. We need to first figure out how much money she's got in her 36% bucket. So we take her income annually. First, we have to get it down to monthly. Remember, we always do this with monthly income when we're talking about qualifying a buyer. So $48,000 divided by 12 gives us a monthly income of $4,000. All right? Now, we want to multiply that times 36%, and that's going to give us $1,440. that's in bucket number 2 for this buyer. So Sandy's got $1,440. If you want to go back to our visual representation, that's bucket number 2. She's got $1,440 in her bucket number 2. And from that bucket number 2, remember we said we had all these things sitting in bucket number 2. So they've asked us how much can she afford for other monthly debt, such as car payments. So this is the other debt part. If we know that the whole thing has $1,440 in it, and we want to know how much we can afford for this, well, doesn't it make sense that we need to take this part out? So that's exactly what we're going to do. We're going to take the $1,440 that's in our bucket, and we're going to subtract out her $940 house payment from it. So $1,440 minus $940 leaves us with $500 that Sandy can afford to spend on that monthly debt payment, such as a car loan, for example. So the total of all these monthly debts for Sandy equals out to be no more than $500. She could spend less than that on monthly debt, but she couldn't spend any more than that on monthly debt. She'd have to stay within that $500 for monthly debt. Now, one thing that's really important to talk about when we talk about these buyer qualification questions is that debt means debt. Be very careful on these questions, on that 36% bucket, that you don't include things like dues. If they say something about realtor dues or, some other kind of association dues or electric bills or utility costs or phone bill or cable bill, those are not debt payments. We're only talking about debt as part of that 36% bucket. So be real careful with that. All right? Now, kind of continuing on with your take-home worksheet here, it says these questions can also be asked in reverse. So we can ask the questions in another way. It says you might be given monthly payments and asked to calculate the necessary monthly or annual income a buyer would need to make in order to qualify for those payments. Now remember, before we were given income. And from the income, we calculated how much money's in the bucket. And then we could figure out how much we could afford for each payment. What we're saying here is that we might sometimes be given, rather than given the income, we might be given the payments. We might say, hey, this buyer wants to buy a house with a $1,500 house payment. How much money do they need to make in order to afford that? And we've got an example here. It says Betsy is purchasing a home with a PITI payment of $1,340, and she has a car payment of $420 and credit card bills of $315 monthly. Assuming she must qualify under the 28-36 ratios, how much monthly income does Betsy need to qualify? Well, when we were doing the buckets, when we were calculating how much money is in the buckets, we multiplied our income by those ratios. When we're told, rather than how much money is in the bucket, when we're told how much the expenses are that are in the bucket, so we're told the credit card bills, and we're told the housing expense, and we're asked to figure out how much money came into the bucket, instead of multiplying by 28% or 36%, we're going to divide by 28% or 36%. So it's just the reverse. It's the opposite math operation. Instead of multiplying, we're going to be dividing by. So let's take a look now at an example. It says, Betsy has this payment of $1,340. We've talked about her car payment being $420. We've talked about her credit card bills being $315 monthly. Okay, and we know we have to use the 28-36 ratios in order to qualify her. Okay, so we take her monthly PITI payment of $1,340. okay, which is right up here. And we divide that by 28%, because remember, the only thing that's in the 28% bucket is our housing expense. That's the only thing that lives in that 28% bucket, that PITI payment and HOA. If she had had an HOA expense, that would have also been in that bucket. But since they didn't give us that, we only have the PITI. So we take that PITI payment, we leave it right alone, and we just divide it by 28%. And that tells us that in order to qualify for a $1,340 house payment, she needs to make $4,785 and change a month. Okay? Now, we're not done. Just like when we were calculating how much the buyer could afford, we had to check both sides. We also have to check both sides when we are calculating how much income they need to make. So, we're going to also look at the total of our monthly debt plus our housing. Remember, that is our 36% bucket. Again, back to our little visual representations, because we like those. That's our 36% bucket. It's got our housing expense in it. It's also got all our other debt in it. So the first thing we're going to do is put our housing expense in there. What do we start with? $1,340. That was our housing expense. And there you go, right there. $1,340 is where we start. It also says she has $420 in a car payment. So we're going to add that in. That's debt. It needs to be added in. That's an expense that has to come out of this bucket. Okay? We're also going to add in her $315 a month credit card bills. And so what we find out is that Betsy really needs $2,075 a month in this bucket. She has to have $2,075 a month in this bucket. Otherwise, she can't afford this house payment of $1,340. That's really what we're saying. So we add them all together. We come up with $2,075, and now we're going to divide that. Instead of multiplying by 36%, because we don't have her income, we've got her expenses. So it's income times 36%, or expenses divided by 36%. Since we're on the expenses side, this would be expenses divided by 36%, which would tell us we would need $5,763 and change of income in order to qualify. Now, again, we got two numbers to work with here. We either need to make $4,785 or we need to make $5,763. Now, when we were doing the first example, when we were trying to determine how much someone could afford, it was the lower number, right? And I said, put yourself in the shoes of the lender. Which payment would you rather somebody have? A lower payment or a higher payment? And as a lender, you would rather them have a lower payment. But this is not payment. This is income. So, again, put yourself in the shoes of the lender. Which income would you rather see a borrower have? $4,785 a month or $5,763 a month? If I'm the lender, I'd rather see somebody making $5,763. So in order for Betsy to qualify under both of the ratios in this question, she's going to need to make that $5,763 a month. All right? So, again, put me on pause and go ahead and work on questions number 1 and 2. You have 2 example questions here as well. So put me on pause for just a second, and I'll be right back, and we will get the answers to questions 1 and 2 on your examples. All right. So, question number 1 says, if Sally wants a monthly PITI payment of $1,580 and has monthly debt of $615, what does she need to make monthly in order to qualify? So let's look at how we do that with a question like this. All right, I've got my calculator back out here. So it says that Sally has a monthly PITI payment of $1,580. We need to check the 28% ratio first. So again, this time we've got expenses, not income. So if we have expenses, we're going to be dividing by the ratios. So $1,580 divided by 28% is $5,642 a month. $5,642 a month that she would need to make in order to qualify for a PITI payment of $1,580. We're not done. We're not finished. We have to check the other side as well. So clear that out. Now we need to check the 36% side. Well, remember the 36% side has the same $1,580 in it. That $1,580 housing expense is also in the 36% bucket. But also in that bucket is this other debt of $615. So we're going to add that $615 to it, and we come up with a total amount of money that's in our 36% bucket of $2,195. That's the number that we're going to divide by 36%. Remember, we have expenses. So we're going to divide expenses by 36. And that tells us that we need $6,097. So again, we've got two numbers to compare here. If I'm the lender, which number am I going to be more comfortable with? This is income. Am I going to be more comfortable with somebody with a lower income or a higher income? And my answer is every time I'm more comfortable with somebody who has a higher income. So we're going to go with the $6,097 a month. She needs to make $6,097.22 a month in order to qualify for this loan. Okay? Example question number 2 here says, assume Beth's monthly PI payment is $785, and the home she wishes to purchase has a yearly tax bill of $1,200. Okay? So she's buying a house with a tax bill of $1,200 a year and a PI payment of $785. Okay? It also has annual homeowners insurance of $600. Beth has a car payment of $350 and a monthly association of realtors dues of $65. What would Beth's annual income need to be in order to qualify using the 28-36 ratios? Well, this has made it a little bit more complex because in the past, every time we've been given the things that are in our 28% bucket, they've been conveniently grouped together for us. We've been given a PITI payment. We've been given all of this stuff added together. It's all been pushed together in one number. But in this question, they gave it to us separately. We just need to put it back together. So we have a monthly PI payment. Get my calculator out here. We have a monthly PI payment of $785. But we also need to add our tax bill to that, and we need to add our homeowner's insurance to that. Okay? So my tax bill is $1,200, but that's annually. Remember, this is a monthly PITI payment, so we need to divide that by 12. That means my taxes are costing me $100 a month. That $100 needs to be added to my $785. Well, the same thing is true of my insurance. I've got $600 a year in insurance. I need to divide that by 12 to find that my monthly insurance payment is $50. So my total taxes and insurance together are $150 a month, plus the $785 that I'm paying in principal and interest gives me a monthly PITI payment, principal, interest, taxes, insurance payment monthly of $935. That's how much is in my 28% bucket, $935 a month. Now that I know that, I'm ready to divide that total housing expense of $935 here, divided by the housing ratio of 28%, and that equals $3,339.29. So in order to qualify for that loan, Beth would need to make $3,339.29 a month. I'm not done. I have to check the 36% side as well. they've told us that Beth has a car payment of $350, monthly association of realtor dues of $65. Well, one of those is debt, folks. One of those things is in our 36% bucket. Car payment. I don't see anything about realtor dues in the 36% bucket. They're not debt. They're not included. You just ignore them. So, when we look at the things that Beth is going to be including in her 36% bucket, we start with the $935 that was in our housing bucket, and all we add to it is the $350 that she pays for her car payment. That gives us a total debt expenditure, the total amount that's in our 36% bucket, of $1,285. $1,285 in our 36% bucket. Well, we're going to take that $1,285, divide it by the 36% ratio, and that tells us that we need to make $3,569.44 a month in order to qualify for that loan. So again, now I got to become the lender. Ask myself, which one am I more comfortable with for my borrower? Am I more comfortable with my borrower making $3,339 a month, or am I more comfortable with my borrower making $3,569 a month? And the answer is I'm more comfortable with a borrower who makes more money, so we're going to go with $3,569 a month. But that's not what the question asked. The question was, how much does Beth need in annual income? What is Beth's annual income? This is her monthly income she would need to make. So we need to multiply that times 12 to get the annual income that she would need to make of $42,833. Hopefully you did okay with those examples. If you didn't, we will do plenty more of those as we go through the class. It's really important you understand this. It's one of those math things that will definitely show up on the exam. It's something you will definitely see as you're tested. So we want to make sure that you're comfortable with it going into the exam. Now, in your book there's one other piece of math that we need to go over. And that is on page 324. On page 324, you have something called a mortgage factor chart. It looks like this. Mortgage factor chart. Okay? And it arranges mortgage payments by, again, this is page 324 of your textbook. Sorry, I dropped the book. And what it does is it gives you a payment per $1,000. Okay? It's a payment per $1,000 chart. And if you look at the one in your book and you look at the columns, the first column are interest rates. The second column is the payment for a 10-year term loan. So that means loans that you have been loaned the money for 10 years. The third column is a payment if you've been loaned the money for 15 years. The fourth column is if you've been loaned the money for 20, then 25, and then finally 30. So the one you would most often use is the 30-year column because that's the most common mortgage repayment time period. So here's how this chart works. It gives you a payment per $1,000 borrowed. So for every $1,000 borrowed, and we'll just take a look at a random one here. Let's say if we have a 9% interest rate, and we're borrowing the money for 10 years. 9% interest rate, borrowing the money for 10 years, we're going to have a monthly payment of $12.67 for every $1,000 we borrow. That's for every 1,000 we borrow. So if we borrow 100,000, we would have to multiply that number times 100 to get our monthly payment. Again, this is payment per 1,000. Okay? So again, I want you to put me on pause. And I want you to look up in your chart there and find me at 5.25% interest, the payment on a 30-year loan. So put me on pause and find the payment on a 30-year loan at 5.25% interest. Okay, hopefully you had no problem finding that in the chart. Let me bring my camera down here. And assuming you had no problem finding that in the chart, you should have seen that the payment on a 30-year note at 5.25% interest is $5.53. But I should write per 1,000 there. So, for every $1,000 of loan amount, we're paying $5.53 a month in principal and interest payments. $5.53 a month in principal and interest payments for every $1,000 that we borrow. Okay? So, if we had a loan of, well, let's do this. Let's say we have a purchase price of $250,000 with an 80% loan-to-value loan. So, a purchase price of $250,000 with an 80% loan-to-value loan. I want you to put me on pause, and I want you to calculate what the monthly payment would be on that loan based on our loan factor, and that's what this is called. It's called a loan factor of $5.53. Okay, so that means at 5.25% interest, what would the loan payment be on a $250,000 purchase with an 80% loan-to-value loan? Go ahead and put me on pause and calculate that. Shouldn't take you more than a second. Okay, so we had a $250,000 purchase price. With an 80% loan-to-value loan, we end up with a $200,000 loan amount. I just took the $250,000 purchase price and multiplied it times 80% loan-to-value, and we come up with a $200,000 loan amount. We divide that by 1,000. Because remember, this payment is per 1,000. So actually, the math step here was 200,000 divided by 1,000. And that told us we had 200 units times $5.53 per unit. And that gives us a total monthly payment of $1,106 on that loan if there's a loan factor of $5.53 per 1,000. So you should be able to, that's pretty easy math, you should be able to look up a loan factor at a certain interest rate and come up with a payment based on that loan factor. All right, let's wrap up the rest of this chapter here on page, let's see, 326, I believe, 327. On page 327. By the way, on page 326, don't worry about the math that they give you specifically for FHA and VA loans. You're not going to have to worry about that. If you can do the 28-36 ratios and you can do a loan factor, you're good to go. On page 327, it starts the finance legislation section. And these are some laws that you need to be aware of and how they relate to you as a real estate broker, even though they are primarily laws that govern lending. Okay, the first one is called the Truth in Lending Act and Regulation Z. So let's talk about the Truth in Lending Act. The Truth in Lending Act requires full disclosure of all finance charges. okay? And that means if you're advertising a loan, you have to disclose all of the charges that are associated with borrowing that money. Very often, we as real estate brokers think we're advertising real estate, but we really advertise things like loans. We do that when we say things like 100% finance available or monthly payments as low as $3.99. When you do that, you're really advertising not just the real estate, but you're advertising the loan that helps to purchase the real estate. And once you start advertising loans, then you fall under this Truth in Lending Act. Okay? Now, one of the things that we really have to be careful of is the part of the Truth in Lending Act called Regulation Z. Regulation Z, and this is on page 328 in your textbook, sets up something called a trigger term. A trigger term. Trigger terms are really easy to recognize. They're numbers, folks. When you advertise a loan and you use numbers to advertise that loan, that's a trigger term. Just like I said, 100% finance available. Well, 100% is a number, and that becomes a trigger term. Payments from as low as $3.99. That's a trigger term. That requires that kicks in some requirements as a result of Regulation Z. So let's talk about what those requirements are. Okay, and they are on page 328 in your textbook, the third paragraph from the bottom. It says specific credit terms such as down payment, monthly payment, dollar amount of the finance charge, or term of the loan may not be advertised unless the following information is set forth as well. Cash price, required down payment, number, amounts, and due dates of all payments, and the APR. The total of all payments to be made over the term of the mortgage must also be specified unless the advertised credit refers to a first mortgage or deed of trust to finance the acquisition of a dwelling. So, they're called the 4 chief disclosures. The things that have to be disclosed, okay? You have to disclose the cash price, the down payment, the number, amount, and due date of all payments, and the APR, the annual percentage rate. Those things have to be disclosed if you use a trigger term. But there's nothing that says you have to use a trigger term. Instead of saying 100% finance available, why not just say no down payment required? There's no number there. It says the same thing. It conveys the same message, but you don't have to do these disclosures. But you do need to be aware of Regulation Z from a test perspective. You need to know what Regulation Z is and know what trigger terms are. You need to know what an APR is, okay? And so the things that must be disclosed, and they're either 3 paragraphs up from the bottom on 328 or 3 paragraphs down from the top. They've given them to you twice so that you know all those things. The loan's APR, all of the finance charges associated with the loan, the total number and amount of all the payments, and the total amount financed. Those are the things you have to disclose. Those are these 4 chief disclosures that they're talking about. Okay, and there are pretty severe penalties if you don't comply with Regulation Z. There is a $10,000 fine or up to $10,000 fine for each day that you're in non-compliance of the law. Okay, so don't run afoul of that law. Just try to stay away from the trigger terms and you'll be okay. All right. The Equal Credit Opportunity Act, which is on page 329 in your textbook, is sort of like fair housing for credit. Same idea here. It makes it illegal for lenders to discriminate in the granting of loans, the making of loans on the basis of, and these are going to sound familiar for the most part, race, color, religion, national origin, sex. Up to that point, they're exactly the same as the fair housing. The first 5 are exactly the same as fair housing. But we've replaced handicapping status with age, and we've replaced familial status with marital status. So for credit purposes, it's marital status and age, not handicapping status and familial status. But it does make it illegal to discriminate on in the granting of credit on the basis of any of those categories. I have had buyers who were in their 80s get a 30-year loan. You can't say, oh, you're going to be dead by the time you have to pay this back, so we're not giving you the loan. That's against the law. If they qualify under all the other guidelines, then they qualify. It's as simple as that. And the loan has to be made. So it makes it illegal to discriminate in the granting of credit to those people. All right. The Fair Credit Reporting Act basically says that all consumers have a right to access their own credit report one time per year for free. That's basically what you need to know there, that each individual has the right to check and correct your credit report, and you have an access to it free once per year. It is a misconception that checking your own credit affects your credit score negatively. It does not. You can check your own credit as many times as you would like, and it does not affect your credit score. If a lender pulls your credit, then that affects your credit score. But you checking it yourself does not. Okay. The North Carolina Predatory Lending Act, just a few things to talk about here, nothing real big. It basically governs the amount of the fees that can be charged on home loans, and prohibits taking advantage of people. But there's no specific things you might be tested on there. Just be aware that there are laws in North Carolina that prohibit you from charging too much when it comes to fees and that sort of thing on residential mortgages. Loan fraud and legislation in North Carolina, there are definitely plenty of loan fraud cases to go around. One of the key things to remember about loan fraud is it always involves two things. Number one, somebody trying to qualify for more money than they would ordinarily qualify for if they followed the rules. So that's number one. Somebody qualifying for a loan that they ordinarily would not qualify for if they followed the rules. Number two, falsifying documents to back up the idea that they qualify for that loan. Loan fraud involves those two things. If those two things are present, then it's loan fraud. As a real estate broker, you may encounter loan fraud in your career. In fact, it's almost guaranteed that you probably will encounter somebody who's trying to commit loan fraud. And the thing you should know is that you can be held responsible for that, and the fines are up to $1 million or 30 years in prison. So please, if you even think for a second that a client is participating in loan fraud, let the lender know and put the ball in their court and out of your control. All right. And the last slide in this chapter, the Real Estate Settlement Procedures Act, which we talked about extensively in class on Friday as part of Chapter 15 with the closing statements. Again, RESPA, the Real Estate Settlement Procedures Act, that's the last piece of finance legislation that you need to be aware of, but it's probably the most important because it governs every residential transaction that involves a loan. And remember, it actually says in all transactions involving federally related loans, but I've just simplified that here and said in all residential transactions involving new loans. Because in this chapter, we've sort of learned that every new loan is federally related because eventually Fannie Mae is going to buy all of them. And since Fannie Mae can borrow money from the federal government to buy these loans, then they sort of become federally related loans whether we want them to or not. And so the moral to that story is every loan, every time there's a loan involved, RESPA is going to come into play, and RESPA governs the exchange of money. It says things like no money can exchange hands without it showing up on the HUD-1 settlement statement. Every exchange of money must show on that HUD statement. It says that the borrower has to get a HUD statement. That's one of the big requirements of RESPA. They have to get one. It says that we're responsible for its accuracy as brokers. That's why we learn how to complete them. RESPA requires, if you remember from Chapter 15 on Friday, RESPA requires that at the time of loan application, the borrower be given a good faith estimate of their charges in that loan. They also have to get that booklet from HUD. But the most important thing is at time of loan application, they get that good faith estimate. And then when we go to closing and they get the HUD statement is going to compare what was on the good faith estimate, the estimate of the charges, to the actual charges that are on the HUD statement itself. So RESPA is extremely important. I hope this this lecture has worked out okay for you. And I really am ultra appreciative of you guys being patient. I know has been frustrating. It's been frustrating for me to try to dodge the doctor in the hospital. Matter of fact, I was in the emergency room again this morning, so I'm glad to have been able to get through this. Thank God for Percocet. It works wonders. But I think you guys will be able to get what you need from this lecture. Obviously, if you haven't, please email me, talk to me, let me know what your concerns are. We will make sure you're in a good place with this information. Listen to it more than once. That's the nice thing about doing it this way. You can go back and listen to it a couple times over and really get this information hammered down. I will once I get this uploaded, I will be updating some other lectures and get some other information up for you so that we can stay on a good timeline with this class. And I will see you all next week. And thanks. Bye.